After a heavily macro-driven week last time around, we're back to the bread and butter of corporate news. And bread and butter might be featuring pretty heavily too, as we have Tesco's full-year results coming up. In fact, it's a big week for retailers all round, and it's this sector that's most likely to write the headlines for three reasons. On Wednesday the 13th of April, we have those Tesco's finals. On Thursday the 14th, JD Sports Fashion will release its full-year figures. And also on Thursday the 14th, we get Debenhams' finals too. Hello, I'm Mark Dunne, AJ Bell's Head of Research, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to be looking at the nation's shopkeepers and how you can assess their 2015 results when they're published. So, first up, we have Tesco on Wednesday the 13th of April. Now, this might surprise some of you, but Tesco is the fifth best performer on the FTSE 100 over the last 3 months, and incidentally Morrison's was number 6. Also, food and drug retailers is the third best performing sector in the FTSE All-Share so far this year, behind only mining and industrial metals. Now, given the sector's well-known pricing woes and the ongoing scrap for market share with the discounters, this may seem odd, but as we have discussed many times before, you can have cheap shares and good news, just not both at the same time. And Tesco's has had a hammering over the last couple of years, as this chart shows. January's trading statement showed a like-for-like drop in sales of 0.5% at group level and 1.5% in the UK. Both improvements on previous periods, and the like-for-likes were up 2.1% overall and 1.3% in the UK for the 6-week Christmas season. Sainsbury's and Morrison's returned to positive like-for-likes in their latest quarters, so let's see how Tesco's final 3 months panned out, but any further improvement in the top-line momentum could be well received by the market, especially as expectations are still pretty low. This chart shows like-for-likes over the last 7 quarters. Besides the like-for-likes, watch out for news of boss Dave Lewis's £400 million cost-cutting plan, talk of any further asset disposals and improved cash generation to pay down the £8.6 billion net debt pile. At least expectations are low in Tesco's case, whereas sports gear retailer JD Sports has raised the bar with a stunning sequence of better than expected numbers, to which the shares have responded, as this graphic shows. Maybe the lower oil price is finally starting to filter through to customers at both Tesco and JD Sports. We shall see, but JD has done a great job in fighting back against Sports Direct, which had threatened to trample everyone on its path at one stage. JD's Christmas trading statement was strong, as like-for-like sales in core brands rose 10.6% year on year, and management declared profits before tax and exceptionals would beat the consensus of £136 million by at least 10%. They're the numbers to focus on, along with gross margins, which were 47.4% at the interims, and the balance sheet, which has net cash after 6 months. Any guidance for 2016 will also be of interest, especially as the stock now trades at a big premium to the market, on 20 times this year's earnings and 18 times next. Even Debenhams look to have had a decent Christmas, and if this habitual discounter can kick the price-cutting habit tendency, it could follow up with another pleasant surprise to follow that provided by January's festive period. That said, the shares have lost momentum of late to suggest someone somewhere has yet to be convinced that Debenhams is on the right track, especially as the stock trades on a PE of barely 10, a discount to the broader market. Analysts are looking for a pre-tax profit, earnings per share and a dividend all to come in at a pretty much flat at 114 million, 7.6p and 3.5p respectively, with low single-digit increases in all three forecasts for this year. Maybe the lower oil price will help, but Debenhams needs to deliver on its target gross margin uplift and keep driving online sales. Watch out also for any news on the identity of the successor to Chief Executive Michael Sharp, who is to step down this year. Note that retail heavyweight Ian Cheshire, formerly boss of Kingfisher, is the new chairman. Thank you for watching, and I look forward to seeing you next time.